Hey guys, Whitney here. Welcome to the Passive Investing Made Simple show. I'm your host, Whitney Elkins-Hutten, Director of Investor Education here at passiveinvesting.com. And I'm so excited you've joined us today. Today, we are going to talk about the money mistakes high net worth investors make. Now, if we haven't met each other already, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at passiveinvesting.com. And this is the whole reason why I invest in real estate is to spend more time with my family. We love spending time in the outdoors and traveling. Anyways, but this is, this hasn't been my life always. I actually started off investing in 2002 when I was working full time. And it was completely by accident. I bought a house with a significant other. And then fast forward a month later, our relationship was crumbling and we split up and I got the house. And, but I also got all the problems associated with the house. And so I had to figure out how to rehab the house, green shag carpets, psychedelic daisies painted all over the walls, straight out of the 1960s. And, but owning that home, learning how to rehab that house put me in a strong, financial position. I didn't know it at the time, but 11 months later, after I completed the rehab, I sold that property for $52,000. Also realized that I hadn't been paying for any of my expenses up until that point in time. And really the big lesson, the big takeaway from that project is that I learned how to unhook my value from the time that it took me to create it. And so fast forward, I did several more live-in flips and house hacks, scaled a 40-unit single-family rental portfolio, then also really dove into scaling my general partnership investments and multifamily, and then subsequently my passive investments. And where I'm at, my husband and I, where we're at today is, we have over 6,500 multifamily units, 2,200 self-storage units, 15 express car washes. And that's just in the active, I get asked quite often, this is in the active holdings part of our portfolio. We have a larger portion in our passive holdings part of our portfolio. But what this has allowed us to do, all of this together, is to create a result for us, for our family, for our well-being, for our finances. And that is to have 100% control and choice in how we spend our time. I love spending my time here with you, educating you on what is this wonderful world of passive investing. How do we navigate it? How do we mitigate risk? How do we create the portfolios that are going to allow us to step into our full potential of ourself and create that impact on the world? And we can help you do that here at passiveinvesting.com. We have very strong, lending arm. We have over 350 million that's been deployed through our rehab wallet lending arm. We have over 1.4 billion assets under management and have made over 51 million in distributions to our investors. Now, today, we're going to talk about the money mistakes that high net worth investors make. Now, this is education, so it's not financial advice, tax advice, legal advice. So make sure to consult with your investing team before making any investment decision. And this is also your call to action. If you haven't done so already, make sure that you are on the Passive Investing Club list. There you get access to free masterclass and boot camps with me. You also get access to a one-on-one call to discuss your investing goals, how we can help you here at passiveinvesting.com hit your goals, and then also priority access to our open deals. So you can either scan the QR code or visit passiveinvestingwithwhitney.com. And if you're wanting to understand how money actually works, how can we, create the wealth, grow the wealth, right? That's where investors, we're very strong at creating wealth and growing wealth. Sometimes we're not as strong as learning how to keep it and then pass it on to the next generation. If you want that blueprint on how to do all four of those things, be sure to check out Money for Tomorrow, How to Build and Protect Generational Wealth. It's available on Bigger Pockets as well as Amazon. Now let's dive into these money mistakes. And some of them are going to be pretty obvious, and then others not so obvious. But there's a compounding effect that happens here. So let's go through the first like 3 or 4 and then we'll start running the through line through if we could take one action, what would it be that helps start eliminating some of these risks in your portfolio? All right. Well, so number one, especially, I see it quite often, being on this side of passive investing, is that sometimes investors, especially even the high net worth investors, don't do the right due diligence on the sponsors. They rely on the marketing materials. They don't quite go through all the motions to vet the track record, the financial strength or integrity of the sponsorship that is running the deal. And there's a lot of different reasons for this, but one of them is they're like you're probably a high net worth professional, you're doing extremely well in your job, or maybe you're running your own business. Maybe you're also a parent, a spouse, and so you have other added pressures at home, and so you don't go through the whole motions. You don't have your system set up. You don't have all the things in place in order to do sufficient due diligence on the sponsorship team. Okay, so again, I'm going to arm you with tools here in a little bit, but this is mistake number one that I see. Mistake number two is, high net worth investors sometimes ignore risk. Okay, they take the projected returns at face value. Maybe they don't critically examine all the assumptions in order to achieve the return. Maybe they don't make sure that the sponsorship they're investing with has stress tested the potential return. And then they're all of a sudden, if markets changed, environments changed, something's happened, they're all of a sudden surprised by losses. And so a lot of what I'm seeing currently is a risk that high net worth investors have taken most recently is they diversified across multiple operators, multiple deals, multiple markets, but they're all concentrated in equity. They haven't taken the risk out of their portfolio by diversifying all across all the different layers of the capital stack, meaning debt, maybe secondary mezzanine debt, maybe even private equity, and then balancing out with equity. Okay, so again, a lot of high net worth investors, they're making great money in their day job, they're making great money in their business, but they take a lot more risk, either knowingly or unknowingly in their portfolio. All right, misjudging liquidity, cash flow, and reserve needs. All right, now there's two different ways we can interpret this particular, money mistake. One is just you invest in a deal and then all of a sudden you're just like, oh, wow, I thought it was getting monthly distributions. And now it's quarterly distributions, or there was a clause in there that they could pause distributions entirely. Okay, so, there's several different layers to pick apart here. Either an investor didn't understand that the preferred return was a hurdle and they just thought it was guaranteed cash flow, or maybe they just didn't understand the timing of the distribution, or they just didn't understand how all the mechanics work there and how their distribution could potentially be disrupted. And then this impacts their financial plans, rightfully so. The second way we can, deal with this money mistake or look at this money mistake is that, even when we as investors invest in other people's projects, we should have capital sitting on the sideline for the what if situations. Maybe you don't want to have a whole pile of cash sitting in the bank. Maybe you want to keep it, earning a rate of return, keep some velocity going. But, even if I own, back when I owned all 40 of those investment properties, each of those properties had reserves to them, but I also had my own personal reserves, just in case there was a larger check that I had to write that the property itself couldn't support. So investors should think about setting aside reserves to cover, unexpected things, on that particular investment, maybe a capital call, or, just thinking through that you should have additional liquidity beyond just writing all of deploying all of your capital into that particular investment. All right, unbalanced cash flow and appreciation. All right, so you guys are watching this on YouTube, you can see the picture of this tree. Half of it has leaves, the other half of it has no leaves. And so anytime we talk about cash flow, I like, talking about leaves on the trees. But, I think investors, especially high net worth investors, sometimes get in trouble and they prioritize yield on the property without considering how all the different pillars of the investment are going to work. Maybe it's the appreciation, or maybe it's like the hold period. So they're just like, okay, great. What return am I going to get? That's all I'm concerned about. And, they don't think through how we need to have balance between cash flow, appreciation, tax benefits, and all the other wealth pillars. Okay, because when you have that balance, you're getting paid multiple ways at once, right? Even if the cash flow pauses, then you can still count on the appreciation, over the long term. And, then you have, if it's an equity deal, then you have the tax benefits that can potentially, support you as well. All right. Impatience with the market cycle. Now, I see this mistake, quite often, and especially in the past 2.5 years, that investors are chasing yield. They're going into a market, regardless of the market conditions. And so their investments are mismatched, according to what's happening in the market. So, if we are looking at this graph, phase 3 hypersupply, phase 4 recession, I think all of us could agree we're somewhere in this phase 3 to phase 4 in most parts of the United States. And so, but, I have investors that I hop on the phone with all the time. They're like, hey, I need to deal with amazing tax benefits. I don't need the cash flow right now, but I need to make sure that it's going to appreciate and I get amazing tax benefits. Well, could we exercise patience and wait for some other market forces to play out and then start deploying that capital in the actual recovery phase of the market, which is coming soon? So things to think about, rise of interest rates, right? I know the Federal Reserve, we're recording this in November 2024, the Federal Reserve has started making some small cuts to the interest rate to relieve some of the economic pressures, but are they just nominal cuts, or are there more cuts to happen? What can you do in the meantime, right? Again, this is all about impatience. People have capital sitting on the sideline. They want it working. I totally get it. Think about adding in a debt layer to your portfolio, because what performs really well in the phase 3 hypersupply and phase 4 recessionary parts of the environment, and that is debt. Okay, so think about adding in a debt layer to this part of the portfolio and consider it to be a, maybe have a short-term liquidity option. That way, if your area of the United States moves through a quicker recovery, then you can get out that money and then deploy it. Another mistake that I see high net worth investors make is just inadequate diversification. And so there's concentrating investments within a single market, a single asset type, maybe even just with a single operator that, increases higher, higher concentrations lead to higher risk. So we want to take care that we're diversifying across property types, geographies, even the capital stack, right? Equity, preferred equity, debt, all of this is going to help create resilience in our portfolio. All right. Another money mistake that I see high net worth investors make is sometimes they get bought in on the hype of things. They're following trends, high demand markets, without really fully assessing the alignment of with that particular investment with their personal goals. And so it can really lead to a bad fit and increased exposure, because of the herd mentality that's happening. Now, guys, I love investing groups. I'm a member of several investing groups. However, I see this particular mistake happen all the time in an investing group. Somebody says, hey, I'm investing in XYZ asset. It's amazing. I've done all my research. I love it. Do you want to be connected to the sponsor? Somebody else chimes in, yes, connect me. You get 3 or 4 others that do it. Then all of a sudden, the next person who pops on, a day or two later said, oh, wow, we've got a new investment, and 15 people are like, oh, this is amazing. It's amazing for me too. I'm going to go in, right? They already did all the work, right? We've got this herd mentality that's happening. So, coming from my time in the tech world, you have to trust but verify. Take a look at that amazing investment that you got put or that was put in front of you, but then go verify that investment against your already preset investment thesis that includes your goals, risk, and your timeline, and then do all the due diligence on the operator as if you had zero due diligence information available to you. All right. The next mistake I see a lot of high net worth investors make is actually ignoring the investment structure and then the tax efficiency. Okay. And guys, I don't actually believe that most people should be investing for tax efficiency. I think that's kind of the icing on the cake. But we want to really make sure that people are paying attention to the waterfall of an asset, and that the waterfall actually has you in alignment with the operator, meaning you're getting your needs met. The operator is getting rewarded if they guide the asset through to success, and that, the operator can't leapfrog you and start taking capital out of the investment earlier than you getting your return. So that's what we mean by making sure that you understand the actual investment structure. But then this leads into, the tax efficiency of it. Are you taking advantage, right? We want to take advantage of 1031 exchanges and, depreciation, all those sort of things. But, we need to understand that the implications of taking care of taking advantage of depreciation, because what the IRA giveth to you, they can also take away, right? So both the investment structure and the tax structure, tax efficiency structure, the asset can impact your overall net return on the deal. All right. Another mistake I see quite often is lack of a defined investment thesis. Now, this is kind of the through line between all those issues that we just talked about, is everything in those first few issues that we just discussed here, due diligence of the operator, alignment on the structure, alignment on, whether you need the tax efficiency or not, ignoring the hype, that can all be taken care of with a robust investment thesis. Now, a great place to start is to make sure that you're writing down your goals, your risk, and timeline. But I would challenge to even dig deeper, make some preset decisions on what you want as far as strategies, risk, communication from the operations team. When you think about risk, what are you willing to take? What are you not willing to take? That way, you're not trying to figure out how to take these robust goals, risk, and timeline and fit them to the deal. You're taking the deal and making it, making sure it actually fits your plan. All right. Now, again, if all those kind of first 8 or 9 issues were taken care of with a robust investment thesis, or at least that's the good starting block here, the fundamental skill that you should have in place, another fundamental skill that would help you as a high net worth investor keep more money in your pocket is make sure that you have a great portfolio review system. Because this is a mistake that I see investors make quite often. At least once a year, I do a portfolio review boot camp. We talk about how to track our investments. And I get so many people on here, they're like, oh my goodness, I'm in like 20, 30, 40 deals, and I don't have a robust portfolio tracking document. So failing to review and rebalance your portfolio regularly can cause misalignment. Especially when we hit challenging market conditions, or maybe you have a change in your personal goals or maybe in your risk tolerance or your timeline, or just really, it just hinders the overall performance of your specific portfolio. All right. Another fundamental skill here is make sure you have the right A team. This is a huge mistake that I see high net worth investors make all the time. And a lot of it is out of, these investors are savvy and they want to save $1. All right. They want to have a great CPA, but they don't want to pay for it. They want to have an amazing legal team, but they don't want to pay the $500 or $600 an hour for them to go through their PPM before they invest. Okay. Attempting to manage investments alone without expert tax, legal, and financial advice can lead to lots of money loss. Okay. Not only just inefficiencies, but a lot of money loss. So make sure you create a great A team. All right. I can speak from personal experience. I remember I was one of those investors that wanted to save money and thought, hey, I'm doing all this. I'm going to learn so much about tax. I'll do my own taxes. And I did my own taxes for years. And then I was like, okay, I need to bring on some help. Okay, I'll do all the work and then I'll just pay a few extra bucks to have somebody else step in and look at my work. And then kind of like, make sure to get my tax preparation across the line. Now, it bit me in the butt one year. My CPA screwed up 2 addresses on 2 of my properties that I had taken the cost segregation on. And yes, that is a very painful learning mistake, because I should have paid for the right CPA, the right tax strategist, to one, take care of all that for me. They would have had all of their systems in place. I would have been trying to save a buck and usurping their system. But 2, they would have been completely versed in real estate, and probably would have never made that mistake to begin with. Okay. Now, cool thing about taxes, you can always file amended returns, but sometimes with an amended return, you end up paying. All right. Now, this mistake, I had to put this in here because I know there are a couple of investments that are outside, I believe, of what's happening in real estate right now. But I see this with high net worth investors. They're super savvy about arbitraging interest rates. So they have access to good lines of credit. Maybe they can go get a loan from the bank at a low interest rate, and then they can find great deals that yield higher returns. All right. But what happens if that deal pauses or has a capital call, or heaven forbid, collapses altogether? I've seen in one case outside of real estate where people are losing millions of dollars because they went and got bank lines of credit and to invest in that passive deal. So using borrowed funds, such as a bank line of credit, to invest in an upside equity deal, adds another layer of liability that if you're going to do that, you need to be able to take on that risk. Because if the deal underperforms or something happens to that deal, you as the investor are still required to pay that line of credit, okay, which really at the end of the day could compromise your financial health. All right, guys, we covered 12, maybe 13 money mistakes that I see high net worth investors make that can cost them hundreds of thousands, if not millions of dollars. If you want access to more information like this, or maybe to hop on a one-on-one call to discuss your investing goals, be sure to join passiveinvestingwithwhitney.com. You can scan the QR code or visit that website. If you're here live, don't go anywhere. We're about to start the Ask Me Anything part of the show. Oh, wow, guys, we got a full house. Yay. I didn't even check. All right, guys, what questions do you have? Well, first of all, I want to ask a question. Was this useful? Did you guys, some of you see like, ooh, aha, I am doing one of those. Maybe I need to unwind it. What was helpful? What did you love? What would you love to see? Because remember, the content that I create is based on your feedback. And then we can just jump into questions that you guys have. I would love to answer them. Regarding number 4, how much liquidity do you set aside for, say, 100,000 real estate syndications? So great question. So I'm when I look at a real estate syndication, I'm probably setting aside 5%. Now for every deal that I go into, for every $100,000, or just like 5% in general, I would just set that aside, but it doesn't mean that I don't invest it. So I set aside 5% and then I put it into like a short-term liquidity note feature. So, since you guys are all passiveinvesting.com, investors are passive investing, or pick real estate debt fund is where I put it, because I'm still getting a higher rate of return on my money than I can in the bank. And then I'm taking that and compiling it for my next investment. So it's not like I just set it aside and forget it. I have it in a liquid environment. So I actually just went through our personal finances. I'm prepping for the One Thing Goal Setting Retreat with Jay Papasan this weekend in August. And so most people will go to these things and they will like do all this work at the goal setting retreat. I'm a nerd. I got it all, most of it done ahead of time, and I'm taking all the information with me so I can make adjustments. Anyways, I sat down and I made sure that I had, how many equity investments do I have? What's performing, what's not performing, how much cash flow do I have coming in? How much do I have set aside in pure cash in the bank, right? I always carry, a couple of months of just pure cash in the bank. And then I have my tiered notes. And then, I have other savings that are set up in my cash flow life insurance policy as a kind of like a deep, deep bank, right? If I stumble across a deal and I don't have any cash, liquid cash in the bank, for whatever reason, great. I'm going to, tap into my life insurance policy. But I tier most of that stuff, that 5% in notes. Now, it's not to say that if you have a capital call, that it's only going to be 5%. Okay, it can be 10, it could be 15. Heck, I've seen one capital call, this was years ago, it was a 45% capital call. And I'm like, ooh, okay. Now, but the chances of all of your investments being in a capital call situation at one point in time, especially if you're diversifying, like we've been talking about, are low. Okay, so hopefully that helps. Now, again, it goes back to what your tolerance is, right? For me, it's 5%. Somebody else will be like, I need 10. I don't want to figure out how to make cash appear out of thin air if I get, pressed for a 15% capital call. All right. Now I want to add on to this one additional layer. We're moving through the roughest parts of this market. Okay, I don't want to put rose-colored glasses on. I still think we have like another 6 to 12 months, maybe, somewhere in there of just some really interesting times and, challenging navigation with some assets. Okay. But if you're going into a new asset, so you might consider setting aside more for assets that say you invested in 2020, 2021, 2022. But for assets that you're investing in now, they're growing in a different part of the market cycle. You might consider, what you would set aside for those, right? So to put a bow on it, also consider where that asset is in the different parts of the market cycle. When we started hitting this hypersupply recessionary phase, I made sure I had tons of cash sitting on the sideline. I'm like, I don't know what's going to happen. Is everybody losing their job? Is all my cash flow going to evaporate from my equity assets? Like, also at that time, I needed more diversification in debt. And I was like, the market is giving me debt. I'm going to do it. Let's see here. Oh, one question in the chat. Sorry, let me get this open. Ah. Oh, there we go. Okay. Oh, I was reminded I needed to get attorney referrals to review my syndication deals. Yes. Yeah, make sure that you have a good quality team at your disposal that love, and trust. Because when you have an issue, that's not the time to go find somebody. Is not to say you can't operate like that, but it just adds so much added pressure. So think about having I consider them my financial board, my tax strategist, okay, my lawyer. Those are my board. Okay, so if I'm bringing on, anytime I bring on a new operator, at the very least, the first investment I do with them, I have my lawyer review the deal. The lawyer is going to poke holes. That's their job, right? There's never been a time that I've given a lawyer a PPM and it hasn't come back with red lines all over it, right? Their job is to find all the different ways that you're going to lose money and scare the bejeebies out of you. Okay, your job whenever you get that is to now ask all the questions and risk mitigate as much as possible to where you're comfortable. Okay. But yes, definitely have your legal team set. What tools, if any, do you use for portfolio tracking? So you can go look on if you go to youtube.com, type in there passive investing .com, so spell out that, and you'll see all of our videos, and there's at least 2 versions of the portfolio tracking in there. For me, I am a spreadsheet whiz. So I love spreadsheets. The reason why I love spreadsheets is because I can manipulate the data any way I want. I can dig in, I can spin tables. I just actually love doing that. Maybe it's the green, maybe it's the Excel green. I don't know. But that's what I use for portfolio tracking. Now, there is an app out there called Vyzer, Vyzer. We have no affiliation with them. This is not a recommendation, but they are, a friend of mine actually created this, and there's some really interesting things to do with it. It's hard for an operator to actually work with them. So you might find whenever you start if you do register with Vyzer, you might find that you can't get all of your operator like updates and financials and performance reports in there, because they make it really actually hard for the operator. They try to make it easy as far as like a connection to the platform, but actually, at the end of the day, it can be kind of hard for visibility purposes. But that, if all of your operators on Vyzer, that could be a good tool. But I have some really great operators that I work with that, they still do pen and print PPMs, but they're amazing. They're amazing what they do. So just don't let that, the technology wag the dog. There's some pretty simple ways to do the spreadsheet, but the tools are also great as well. What other questions do you guys have? Was this useful? Okay, so we only had one person out of all the people that are on here that said I had a takeaway. I want you to go to the chat box. I want you to tell me, what is the one thing that you went, ooh, I need to do that. I need to get this mistake out of my portfolio today. I want you to, everybody that's still here should drop something in there. Another comment, all great advice applicable when considering new investments. Do you actually, all of those money mistakes, we need to hedge now. You can start thinking about those now, get them in place now. Okay. Do you hedge new risks while holding existing illiquid investment positions? For example, how to hedge risk if interest rate rises again. I'm not sure what you mean by hedging risk. So if you can give more clarity on that. So the way that I'm reading that is if I'm looking at, if I have, because I have some, investments in my portfolio that still are, under stress from the rise in interest rates. And what am I doing right now to counterbalance that risk? One, having more cash in case they experience a capital call or an issue or something like that, right? Two, because I have more of that cash, I'm actually creating, and I don't like holding in the bank, I have it in short-term notes. I'm creating diversification over the various capital layers, right? Three, I'm paying far more attention on tracking that particular investment in my portfolio tracker. So I have a column in my portfolio tracker that I put in the latest monthly update, just like a cool little 2 cents. Like what's happening, at that, not even 2 sentences, just what's quickly happening at that asset. Another part of my system is all my monthly updates go into one folder on my G drive. I'm not a nut. I don't try to keep it super, super organized, but anytime an update goes in, I read it, I throw it to the folder. Okay. How am I, if you're already in a deal, like the operator is now at the helm to hedge the risk through the remaining hold of the asset. If you're looking at a new deal, how am I going to hedge risk if the interest rates rise again? Well, I think, number one, I want to look for longer hold times on the asset, and I want to look at better debt positioning on the asset. And also I want to look at, the supply demand of that particular market. Those are the three big things that I'm interested in as far as risk mitigation standpoint. Now, as far as a element of the deal, I want them to be in an area where taxes aren't high and insurance rates aren't high, but that is decided before the deal. Those other three things are going to move as the deal is held. So hopefully, those are all going to be on your due diligence list. So put a pretty bow on it. Get capital, stay liquid, build out that, multiple layers, diversify across the capital stack. And at the end of the day, run make sure the deal fits your investment thesis, make sure the deal fits your due diligence. Ooh. We got all the numbers that populated in here. I need to track my investments. I need to focus on liquidity. I need to focus on building my team. Awesome. Now, what are you going to go do about it? Do something about it. Number 4 was an aha for me. Okay, I got to pull back up. What was number 4? Yeah. Okay, perfect. Yes. What kind of question would you ask a syndicator or operator about insurance rate growth? Well, I would ask them for their underwriting. What are they, well, first of all, if you look at their pro forma underwriting, are they putting in increases for insurance? So that's number 1. 2, you can fire back the question. It was just like, what do you see happening in this particular market over the hold period of the asset as far as insurance rates? And they might have done some research already. They should have, and they'd be like, oh, rates, already reset in the market last year, so we should be good for a while. Or like, hey, we're anticipating like, we built in a 10 or 15% increase in 2 years just because we don't know, because they don't control the interest rates, right? The operator does not control the interest rates. Their job is to try to have as much of a crystal ball as possible, right? And still be realistic to the deal. Now, there are certain, so the other thing that affects insurance rates, one, as we have more natural disasters across the United States, everybody's insurance rates go up. Okay, so don't think, you might live in Albuquerque, New Mexico, and you think like, hey, there's no natural disasters that happen here. I'm safe. No, you're not. As we experience more natural disasters in every part of the United States, everybody's insurance rates will go up. Okay, the insurance carriers are trying to hedge risk, but some areas are going to go up faster than others, right? Like Florida with hurricanes hitting back-to-back hurricanes. They just had huge insurance leaps like in the past 2 years. I can't see a path where there aren't more, right? So think, we're unfortunately some parts of Carolinas, I would imagine their insurance rates will increase too as they rebuild. Ooh, a lot of questions came in. What do I see as a few high risk in the next few years for multifamily? Roy, go ahead and give me some more clarity on exactly what you're trying to ask there. I think the biggest risk for multifamily is going to be is how supplies can be absorbed in most markets in the next 12 months. And then multifamily actually should have a nice run up again before the construction comes back online. Right. So I think we're poised for multifamily to hit another growth period. So the real risk is going to be, is the operator, one, do they know how to operate the asset? Two, like, are they risk mitigating everything, your typical underwriting? Now self-storage right now is going through a challenging time. So I think there's some risk in play there. Who would I talk to take a look at my current investments and help me plan? Tax, CPA, Whitney. Yeah, well, for one, you can reach out to me. I do individual coaching. Guys, I'm not a financial advisor. Okay. Like I just, I can't do that. I can't connect you to other operators, but I can help you think through these questions for sure. But if you're wanting somebody outside, if you're looking for somebody to be like really hands-on with you with your investments, you can think about doing what a fee-only fiduciary financial advisor. But here's the catch. It has to be somebody that has experience in real estate. Okay, syndicated real estate. And 99% of financial advisors are not. Now, I interviewed Christina Suter this past summer on the Passive Investing Made Simple Masterclass. She's an option. She's in California. She herself is in real estate. She understands syndication. She includes it as a slice of the pie in somebody's portfolio. So you can, definitely do that. But one of the things is learning how to build your own investment thesis. And part of that is learning from your current portfolio, but also understanding like what you're willing to do and not willing to do. And then once you have all those decisions in place, now go find the investments that fit that like 90 to 95% of the time. Have I seen insurance rates start to reduce or settle down? Not really. I mean, insurance rates will fluctuate, but right now, I haven't seen them settle down. I think they've stabilized for sure in a lot of different areas, but I haven't seen them come down. Can you try to get a carrier that isn't nationwide with fewer losses on their books? Well, oh, that was the statement. Yeah, you could do that for sure. Yeah, so that's, one of the reasons like operators will work with brokers to kind of shop all the different, insurance carriers to see if they can strike a deal. But also if the broker has buying power, they can leverage that as well. Is the economy the root cause of your concern about multifamily real estate in the next 12 months? Not really. Uh, I think it's more over like, have we absorbed all the supply in certain markets? I think that's kind of the biggest unknown in a lot of real estate markets is what kind of competition, supply demand is still out there, and am I going to be able to raise my interest rates or not interest rates, raise my occupancy rates and my rental rates accordingly? And then does the economy play into that? For sure. I mean, but it's all tied together, right? If we have the bottom drops out of the economy and, we have huge job loss, of course, that's going to impact multifamily. It is. But those are things that are beyond our control. Guys, here's the thing. We can mitigate is influence. When we look to risk mitigate on our deals, we're trying to influence how many factors of risk are at play. Can we control all the risks and eliminate it from our portfolio? No, we cannot. If you are choosing to be an investor, you are choosing to take on risk to get a reward. Let me say that again, or a different way. You will only get paid if you take on risk, right? We take it every day. We take on the risk of trading our time to a business or to building our own business in order to get paid, right? We take on risk all the time, okay? So we just need to think about that. Even if you're just like swearing off real estate and you only want to do stocks, bonds, and mutual fund, you need to know what kind of risk you're taking there too, because you are, right? We cannot eliminate all risk. I wish we could, guys. Let's see here. I'm going to jump over to chat. I'm reading Money for Tomorrow now. I'm going to discuss chapter 5 with the 95-year-old uncle for whom I'm an executor. Yes, I love that. Get your strategy. So one of the things that we talk about is like how to pass on wealth to the next generation. And the tools to do that, like wills and trusts, are just like one piece of the puzzle. But we want to make sure that they all have, that we all have our capacity plan in place, but also have we trained our executor and our heirs. That's another part of, passing on wealth. So that's what Matt's referring to. Is it ethical for an operator who is going through a foreclosure on a past deal to not include it on their track record while they're raising funds for a future deal? I don't like that non-transparency. Just gonna say, it wouldn't sit well with me. If they're not, that's a hard one, right? Because, everybody wants, it's kind of like, okay, so my daughter, guys, we're all friends here, right? We've been together with each other for an hour. My daughter came home. She's back in school after being out. We schooled from home because of COVID and then because we love traveling. Okay. But this is her first foray back in like in-person school. She's a tween. She came home and she was like, finally, we got to some real conversation. And she was like, Mom, the kids told me they didn't like my shorts and my pants and my hair. And, I don't know if you raise your hand if you have a tween girl, right? Sometimes tween girls can be kind of mean. Anyways, and I was like, oh, okay, honey, I gave her a big old hug. Where I'm going with this is that everybody wants to be liked, right? So they're trying to, the operator, if I step into the operator's shoes, they're trying to market themselves. Now, should they put it on the track record? I would, but it's the limited partner's job to ask the question. right? That's where you as the LP need to empower yourself to always ask the hard questions and see how the operator responds. Okay. Now, if you ask the question, hey, I heard you guys are going through a foreclosure. Tell me more about that. What's happening here? And how it's impacting your portfolio. And they lie to you, big red flag. Otherwise, again, for me, I would ask way more questions of why they didn't put it in their track record. But is it unethical? Ugh. I can see why they didn't do it from a marketing standpoint. Can we assume higher vacancy rates when underwriting to mitigate absorption issues? Oh, going back to supply demand. Yeah, so, you can look at the operator's underwriting and, one, make sure that they are accounting for physical vacancy as well as economic vacancy. So, because there's two different things, right? If we got a supply demand, issue, now we've got physical vacancy coming down, but we also want to make sure that vacancy rate takes into account, should we hit a tough market, and people are still in place and we are in the process of evicting, does it take into account economic vacancy? Okay, so we saw that during COVID. A lot of people were looking at market vacancies and the physical vacancy in the market was 2 or 3%. But then all of a sudden our physical vacancy still stayed at 2 to 3%. But when the economic vacancy popped up to 7, 8, 9%. Okay, so I always want to take the market vacancy and double it. And that's just kind of like the line in the sand for me in my head. So we want to make sure that the operator is stress testing that. Let's see. Ooh. Somebody said, completely agree. We're in the business of taking risk in return to getting rewards. Thank you for the reminder. Yes. And you as the investor are solving problems. You're taking a risk to solve a problem to get a reward. Okay, so let that one sink in. Make sure that you're continuing to solve problems in the environment. Based on your comments, looks like new multifamily deals that are underwritten per current challenging vintage should be relatively resistant in coming years. Is my understanding of your comment accurate? I would think so, yes. If the operator is actually using, learning the lessons and applying those lessons to their current deals, yes, you could assume that. Right? Because another way that I look at it, operators that are still standing today and navigating their portfolios are in a far better position than operators who either are just coming online or who poofed in the past 2 or 3 years. There's a lot of teams that have are no longer raising on deals. They've had to take on other sources of income. So operators that are largely still standing today, it gives me a lot of hope that they're going to navigate the remaining part of the cycle. Let's see here. I think we've almost gotten through all the questions. There's one here, for example, existing investment position that have floating interest rates. Ooh, let's see if I can go back to the original question. Oh, that was related to how do I hedge risk if interest rates rise again? Okay, so so I think I understand where you're going with this. Okay, so if a property was purchased in 2021, 2022, still has interest rate debt on the property, and you are concerned that the debt's going to interest rates are going to go up again, and so what's going to happen with that property? So most operators right now that have properties like that, they're either trying to stabilize by putting a new debt on it, Just get it out of the floating rate debt, put it in a new term debt. We haven't seen a lot of that happen because operators are looking for the interest rates to come down, drop further before that actually makes sense financially to do that. And it will probably require a cash in refinance to get that done. Okay, meaning some sort of promissory note will go on the asset, some sort of pref equity will come in the deal, or even, if they don't want to insert those other layers, a capital call. Now, here's the thing. A lot of people are like, capital call, red flag, bad. Is it ideal? Of course not. We all want the original business plan to work. However, I would much rather have a capital call as a limited partner, have a capital call and maintain all my shares than to have somebody come over me like a pref equity or a promissory note and liquidate me. Okay, now there's ways to structure it where that doesn't happen. The liquidation doesn't happen, but not all operators, have the wiggle room to do that. Okay, so that's one thing. How are they restructuring the deal in order to get it stabilized? Okay. Another way they could try to, stabilize the deal is just sell, get it off the books. Even if we break even or take a teeny loss on it, just sell, get it off the books. Okay. Everybody gets majority of their original capital back. They can live to see another day. We fulfilled capital preservation for the most part, and everybody else can go into a new deal. Okay, that's another way. Another way, that they can do this is to raise money or add money to the deal to continue to purchase the next interest rate cap, the next extend the loan and all that to get them to to buy another a year and a half or 2 years to then figure out what either the next move is, whether it's the sell. So kind of kick the can down the road to figure out if which of the first two options are going to work. Okay, the last thing, and this is a viable option. Okay, nobody likes it, and it's just the deal does not work. They're going to give the keys back to the bank, and everybody loses. That is a viable option. It's not one that anybody wants to see. So if you're looking at a deal and you're trying to, and this reminds me, I have a note to myself on my desk. I need to probably do another educational session on like how we view capital calls and how to make that decision to invest in a capital call or not, or contribute to a capital call. Long term, what I'm trying to say there is unless you are just like done with the deal, no time and attention, you have zero faith in the operator, zero faith in the market, zero faith in the deal, and you just want to be done and out, like call it a day, like you should be fighting with your operator to get one of the first two options done, which is to figure out how to get it restabilized or sold or restabilized. Okay. So that kind of plays into this whole floating interest rate things. If you're in that camp where the deal needs to be extended, then yeah, you're still at a potential risk of interest rates to go up, even if you put another rate cap on there, because it can hit that rate cap. And if it goes up further and your time clock ran out, and you still don't have a plan, okay. But what most people are trying to do is to buy themselves another 18 months to 2 years to figure out those puzzle pieces on either, are we going to hold for 5 to 7 to 10 years and make some real money off of this? Or are we just going to like, get this back to neutral and get everybody their money back? Hopefully that helps. That wasn't a fun way to end the webinar. So hopefully we got another like positive question. Somebody said, great session. Yay, I appreciate you. Absolutely. Okay. Guys, if you have any questions at all, feel free to reach out to me at whitney@passiveinvesting.com. A lot of great questions, very active group today. I really appreciate you taking the time to be with me and invest in yourself. This has been super fun today. Yes, you're welcome. Happy to help. Happy to help. Otherwise, we actually have a boot camp tomorrow. I'm kicking off, starting right back at the beginning. If you are a new passive investor, we're going to dive into all the lingo. So if you're like, you said, prefer return, capital call, cap rate, all these things, I have no idea what you're talking about. Be there tomorrow, 11 a.m. Mountain Time. All right, guys, take care, and we will see you soon.